Hello, Travis with Tetelestai. We talked about Schedule Cs and sole proprietorships and single member LLCs. Now we're going to talk about partnerships and the tax form that's associated with them. This is called a 1065. So we're going to focus on what's different. Similarly to a Schedule C, as part of a 1040, you have the income and deductions or expenses. There's another schedule in here, Schedule B. And then the Schedule K we'll talk about later. What I want to focus on is the Schedule L. So this is where the business has a balance sheet. And this is important because this should, for the most part, match your books, whether that's in QuickBooks Online or something else. You're going to have a beginning and ending balance for assets. So you have your cash, in other words, your bank accounts, your liquid assets. Accounts receivable, if that applies, and this would relate, if you recall, back up to your accounting method here, cash or accrual. If you're using AR, that's typically accrual. Inventory, beginning and ending, if you're using that. Then you have loans to partners, other current assets, mortgage, real estate, other investments. And you see here, no attached statement. We'll talk about that. Buildings, and then depreciation. Buildings are depreciable. Land is not. That's separate down here. Intangible assets, this would be things like startup costs. And then you have your total for your assets. So you should be thinking again in terms of a balance sheet, assets, liabilities, equity. They're calling it capital here. Accounts payable, if you're using that, if you're using bills along with vendors. And money that you owe. Since mortgages up here would be, since they're assets, these would be notes that you held. You're the lender. Down here, you're the borrower. Loans from the partners. It's a little confusing. Up here, they call it loans to partners, which is the correct nomenclature. That loans you make versus loans that you take out. And then the total liabilities and capital, of course, equals your total assets. So this is the difference between a partnership and a sole proprietorship or a single member LLC, which the IRS calls disregarded entities. In other words, it's just going on the individual income tax return, the personal income tax return. Partnership is different. So the business has a balance sheet. And then you have the Schedule Ks and the subsequent K1s that go along with that. We can talk about that separately. Mainly wanted to talk about the difference between a partnership here and the Schedule C is part of the 1040 for a sole proprietorship. Any questions, post them and I'll be happy to answer. Thanks.